Markets usually cheer bad data, but this time they hesitated. US jobs figure were weak, yet not weak enough to force a rethink on Fed policy. Across the Atlantic Ocean, there was even less to celebrate. Rising unemployment in the UK and softer inflation gave the Bank of England the green light for this week's rate cut and probably a softer outlook for what's coming as well, but also pointed to an economy cooling faster than policymakers and lower interest rates could fix. So welcome to Swissquote's Daily Market Talk. We are December 17th. I'm İpek Özkardeşkaya and everything that I will share in this video are based on my own opinions and this is not financial advice. Markets didn't like the mixed jobs data from the US yesterday. That's odd because the data was actually quite bad. And investors like bad data because the softer the data, the higher the chances of rate cuts, the lower the yields, and the higher the valuations. But apparently this time it wasn't that. The US economy actually added around 64,000 jobs in November. That was better than 50,000 job additions expected by analysts and way better than more than 100,000 job losses on the previous report. But the unemployment rate rose from 4.4 to 4.6%. The highest level since the pandemic months. And the Fed actually acknowledged last week that the job numbers as we see them printed could be around 60,000 higher per month compared to the reality and could then be revised lower at some point in time. The average hourly earnings on the other hand also fell in the US. The retail sales data was soft as well, though the softness was mostly due to car and gasoline sales. Otherwise, it would have been stronger. But overall, there was little doubt that yesterday's data from the US was soft enough to back the Fed dollars and further rate cuts if investors wanted to go that way. And indeed, the US 2-year yield that captures Fed expectations fell to 3.45% level before rebounding back to the 3.5% mark. So a part of the dovish Fed expectations actually got priced in yesterday after the data, but equities barely moved. The S&P 500 was rather sold. The small cap index in the US was down, and Nasdaq 100 index with its technology-led growth stocks eked out a small gain. So if you were expecting a different outcome, a different reaction to yesterday's data, you were right. We could have seen the exact opposite market reaction to yesterday's soft jobs data, and it would be much easier to comment. So my interpretation of the market reaction to yesterday's US data was that the US jobs data was sluggish, yes, but it was not bad enough to convince investors to change their Federal Reserve bets and get them to take on more risk. Consequently, the market pricing continues to point at 2 Fed cuts next year with a near 50% chance that the next cut from the Fed would arrive by March. Now, all eyes will be on Thursday's US inflation numbers, of course, that will provide the last piece of the Fed's puzzle for this year. Whether the Fed has the luxury to cut the interest rates and by how much. The slower the inflation, the more the Fed could help. Until then, the market mood will likely remain contained. Now, good news for Americans is that they are not Brits because yesterday's US jobs data looked fantastic compared to the United Kingdom's that was really, but really bad. Unemployment in Britain rose to 5.1%, the highest in 5 years. The UK economy lost some 187,000 jobs since the Labour government's first budget was announced. The youth unemployment sits at a scary 13.4%. 13.4%, guys. This is a level that you'd expect in countries struggling with chronic labor market dysfunction, not a G7 economy. But happily for the Bank of England, the wages growth in the UK is weakening so that the Bank of England could step in and try to clean a part of the mess with lower interest rates. But lower rates will hardly remedy in the long term to the waning UK economy because those 187,000 job losses means that all these people are not paying their taxes anymore. They rather cost to the UK's government, meaning that next budgets from the UK will have to be more restrictive than the previous ones at a time investors are no longer willing to finance the UK's debt at cheap prices. This is a terrible spiral. The 10-year gilt yield in the UK is pushing higher despite the dovish Bank of England bets, and that's generally very, very bad news. Interestingly though, sterling was stronger yesterday, both against the euro and the US dollar. But this morning it is down with the softer inflation data from the UK, and it seems natural to me to expect a softer sterling moving forward, both on the back of sluggish economic outlook and the dovish Bank of England divergence. Released this morning, the UK inflation numbers came in softer than expected, justifying very clearly a softer stance from the Bank of England. But whether it will help, we will see. I think that this week's data and the Bank of England decision could eventually mark a top to sterling's November to December rebound. A rare spot in the UK, though, is its FTSE 100 index, full of energy and mining companies, some of which have done exceptionally well this year. And I'm looking at you, Frenilo, for example. That's a gold miner that rose by around 420% since the start of this year, as gold rallied exponentially past the $4,300 per ounce level. Bitcoin investors have got something to be jealous about, Frenilo. And considering the sweet combination of softer Fed expectations that weigh on the US dollar, the waning appetite for US treasuries from the rest of the world due to exploding US debt levels, and the tense global geopolitical backdrop, it makes sense to expect fresh all-time high levels in gold before this year ends. It's a very easy call indeed. Silver soared another 4% this morning to a fresh all-time high level of $66 per ounce in Asia, and platinum also follows the complex higher. If the question is, has the metal rally more room to run? The answer is probably yes. Oil, on the other hand, shortly slipped below the $55 per barrel level at yesterday's trading session, but rebounded on news that Donald Trump ordered the blockade of tankers going into and leaving Venezuela this time. This is much bigger than last week's seizure of sanctioned vessel, mind you, because here we are talking about an action against an OPEC member that will impact oil supply, hence could impact WTI and Brent prices as well. As such, we actually see a sharp rebound this morning in WTI prices. But this being said, do not forget that the geopolitical-led price spikes in oil prices tend to be short-lived. And Venezuela exports a bit less than 1 million barrel per day of crude to the world, which is quite slim, mind you, and the oil market is dealing with a growing supply glut, which would be around 3.8 million barrels per day into 2026, according to an earlier IEA forecast, which makes the Venezuelan loss of 1 million barrel per day quite bearable, to say the least. Therefore, I believe that the latest rebound in oil prices due to the Venezuelan stress could remain short-lived, and the $55 per barrel support in WTI could come under a renewed pressure when the Venezuelan dust settles. Well, I will end this episode on a fun note. Another Chinese chipmaker, Meta X, went public today and rallied up to 755% in its trading debut, reaffirming insatiable appetite for bets that could make wild swings in a few days before the trade dies out. This is exactly what happened with More Threads. Remember, another Chinese chipmaker that has gone public earlier this month. Its stock price also printed a mega upside push of around 500-600% on its first day, and now the bubble is deflating. Meta X 700 something percent gain will probably fade as well, but the whole thing gives you an important hint about appetite and where investors actually throw their money. Because appetite for risky bets like this one is still there. Technology names get the full attention from those who want to take these bets, and although the broad AI rally seems to be weakening these days with all the overspending worries and the leverage worries, investors just need a fresh trigger to jump back in. So whatever the fundamentals are, the dreams weigh heavier. Look at Tesla that just hit a fresh all-time high level yesterday on robotaxi dreams. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below, as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos, and even send us a message to tell us that you enjoy these videos, if you enjoy them, of course. So I will meet you again tomorrow. And until then, good day trading.
Trading and investing carry risks, including capital loss. CFDs in digital assets are volatile and not suitable for everyone. Swissquote assumes no responsibility for accuracy or losses from its use. Products and services are offered only where legally permitted.